This is part B of the video titled Analyze, Record, and Post Adjusting Entries and Prepare Adjusted Trial Balance. In part A, we worked through items 1 through 6 and recorded those adjusting entries. This is now part B, where we will work through items 7 through 20 and prepare the adjusted trial balance. $300 of equipment depreciation needs to be recorded. Depreciation is simply the expensing of a long-lived asset over the periods that are benefited. If we depreciate $300 of equipment, assets will go down and expenses will go up, thus decreasing equity. The account we're dealing with is equipment, which shows a debit balance of $2,000, and we're saying we need to reduce it by $300. But rather than crediting the equipment account itself, we're going to have a contra asset account called accumulated depreciation. What this is, it's just an account that helps us keep track of how much of this equipment we've depreciated. The related account is depreciation expense. Therefore, we should have $300 of depreciation expense debit at the end of the year, and accumulated depreciation for equipment should be a credit of $300. How do we go from the wrong pre-adjusted numbers to the right adjusted numbers? We would have to increase our depreciation expense $300 and increase the contra asset accumulated depreciation $300. On the balance sheet, the equipment will be reported at $2,000 minus the $300 of accumulated depreciation. So the net book value of equipment on the balance sheet will only show $1,700. This is another depreciation example. We need to reduce buildings by $6,000 of depreciation, thus reducing assets, and due to that additional expense, reduces owner's equity. The account we're dealing with is building debit $200,000, which we need to reduce by crediting at $6,000. But as with receivables, we use a contra asset account, accumulated depreciation building, into which we'll put that $6,000 reduction. So whether the credit is up here in building or the credit is down here in accumulated depreciation, the net effect is the same. Depreciation expense already shows the $300 of depreciation from the equipment, and we need to compute what the ending balance should be. It should be $6,300, which would include this depreciation on the building. And accumulated depreciation on building should be a credit of $6,000. How do we go from the wrong numbers to the right numbers? We'd have to debit depreciation expense and credit accumulated depreciation building. We estimated that $350 of utilities were used but not yet billed. If that's the case, we would have to show that we owe $350 more, call that an accrued expense, and since it's an expense, we will have to reduce our equity. The pre-adjusted balance in utilities expense is $3,040, which probably represents 9 months so far in the year X1. We know that it should increase by another $350, so the ending utilities expense should be $3,390. We haven't paid yet, so our ending accrued expenses, which is a liability account, needs to be a credit of $350. The adjusting entry that would take us from the wrong number to the right number would be a debit to utilities expense, thus increasing expenses, and a credit to accrued expenses, thus increasing liabilities. Interest at 5% needs to be accrued on the note payable. We had a $160,000 note payable, so we will have to accrue interest on that. Our liabilities will go up because we haven't paid for the interest yet, and since we have more interest expense, we'll have to reduce equity. Our opening balances in these accounts are zero. The math to compute interest expense would be the $160,000 loan times the 5% annual interest rate times 10 out of the 12 months of the year have expired. Therefore, $6,667 of interest expense should be accrued and still payable. That would be the ending balances for interest expense and interest payable. The adjusting journal entry to go from the wrong numbers to the right numbers would be a debit to interest expense, $6,667, and a credit to interest payable, $6,667. I've rounded this to the nearest dollar just for display purposes. 2% commission has not yet been recorded on a $1,000 sale. If we haven't recorded it yet, that also means we haven't paid it yet, so we would have to increase our liabilities for that commission payable, and due to the increased commission expense, we'd have to reduce equity. The accounts involved are commission payable and commission expense. By taking $1,000 times 2%, we would show that we need to record $20 of commission expense. If we were to tack that commission expense onto the opening balance of $4,020, we would have an ending commission expense of $4,040 as a debit. And we would show that we have a $320 credit balance payable in our commissions payable. The adjusting entry would have to be a commission expense debit 20 and commission payable credit of 20. One last thing, we need to compute income tax expense. The way you compute income tax expense is you determine net income before taxes and then you multiply it by the appropriate tax rate. It's a little more complicated than that, but we'll simplify it here. Total adjusted revenues are $200,800 and total expenses are $81,307. So the income before taxes is $119,493. Assuming a 40% tax rate, that comes out to $47,797 in income taxes for the year. The journal entry, therefore, would increase our liabilities as income taxes payable, and the increased expense would reduce our owner's equity. The accounts involved are income taxes payable and income tax expense, which open with zero balances. But the adjusted trial balance should show income tax expense debit of $47,797. And since we haven't paid yet, income taxes payable should show $47,797 as a credit. The adjusting entry to get to the right balances would be debit to income tax expense, $47,797, and credit to income taxes payable, $47,797. We've just gone through a whole bunch of adjusting journal entries, and now let's summarize and see what we've done. Let's see what we've accomplished. We analyzed, recorded, and posted the adjusting journal entries, and now we're going to look at preparing the adjusted trial balance. This is an example of a trial balance worksheet that some companies use in preparing their adjusted trial balance. They bring in their pre-adjusted trial balance numbers, and then they show the debits or credits they think they need to properly adjust the accounts and compute what the adjusted balances are. Then they go back and make sure the journal entries were properly recorded and posted in the actual accounting information system. But this visually lets them know what the numbers should be. So here's the first page, and here's the second page. The debits of all the entries from page 1 and page 2 equal the credit of all entries from page 1 and page 2, and the adjusted trial balance with debits showing as positive numbers and credits showing as negative numbers adds up to 0, showing that we have an adjusted trial balance that balances. This is the adjusted trial balance that will now be used to prepare the company's financial statements, which we'll discuss in the next video. I know there was a lot packed into here, but I hope you see the flow of the accounting cycle. We'll now move on to preparing the actual financial statements based on the adjusted trial balance. So I hope you get the big picture and that you're ready to take the quiz.